Hey everybody, hope everyone's doing well. This is the Emini end of day review for Friday, August 2nd, 2024. And coming into the day, we know it's Friday, so weekly support and resistance will be important. And I thought this stop order buy, this was a weak signal bar. The market was likely going to come back and test it. So when we're rallying for a couple of legs up, this magnet is still in traders' heads. This should not have had a strong breakout with follow through. And then you get the strong bear bar. And then what we have here is a bear trend bar, decent looking reversal, but tight bull channel, follow through, kind of a pause bar, and then a second leg down, implied pullbacks in here. And this bar is even bigger than the first bear bar, so a little climactic, the first test of the moving average in many bars. I think less likely the market just continues to crash down here. More likely we are evolving into a trading range. Now we don't know if the trading range bottom is here. It could be down here. But we know it's somewhere below and that this breakout was strong enough for a second leg down. It is a micro channel on this chart. The odds are there's sellers above the past 3 weeks. And then coming into the day, on the daily chart, the bears broke this tight bull channel trend line. A couple of legs down, but pretty tight. We'll probably get a second leg down. Then we went sideways, maybe a two-legged pullback. And the 31st of July may have been a second leg trap. We rallied, pulled back, and then had an even stronger looking rally. But if you remember what the day actually looked like, at least the day session, we know it was a trading range day, and then they got rejected pretty violently yesterday. 2-bar reversal, low 2 short below yesterday's low. Probably going at least a little bit lower, but this looks like a trading range. Lots of trading range price action, overlapping bars, maybe 1, 2. A third breakout would be 3 legs down. You could even draw it up here, starting from up here. Something like this, 1, 2, 3. So the odds are there's support not very far below. But again, I showed this on the weekly chart. We could come back down and test here, or we can come all the way back around here and test near 5,000. But coming into the day, there was an increased risk of fading a downside breakout because of the momentum, two-legged pullback, increased risk of a second leg down, and the buying pressure isn't very good. This looks like a trading range for the bulls. Maybe it's enough of a trendline break that a retest might fail and we could have a major reversal. But traders are paying attention to the momentum of the retest, in this case of this bear trend's low. And obviously, yesterday there was a lot of momentum. Small pullback, bear trend. Probably not the best to buy below it. And then coming into the day, we had a big gap down. And coming into any day, I think it's good to look at the Globex chart, especially when there's a big gap and you're missing information. You don't know if the market's been in a trading range or if it was trending overnight. It's good to look at that and see. So here's the close of yesterday's day session, and here's the overnight session. And right around here is the open of the day. So the market was in a bear channel. All the bars, basically all the bars, completely below the moving average. maybe one close above the moving average overnight. So it's a pretty strong and tight bear channel. So it's not a big down, big up, big down, gap down, more of a trend overnight into today. With gaps in general, there's an increased risk. The gap gets followed through, at least another leg in the direction of the gap. And then you combine that with all of the context, small pullback, bear trend. You look at the overnight session, it's a tight bear channel. And then we look at today. And we have this big gap down and then a bear bar, a bear trend bar. On bar 1, the market's accepting the gap down. We're probably going lower. The gap down plus bar 1 is a bear breakout. At least breaking out of this swing point. Bulls hoping this was a trading range. They bought below, hoping they could scale in, but the gap down and bar 1 is trapping them. So the bulls are desperate for any bounce to get out of their losing longs, and the bears who didn't sell are also desperate for a bounce so that they can short and catch the second leg down. Bar 1, with the big gap down and a bear bar for bar 1 closing on its low, it's probably always in short and okay to be short with a wide stop, probably up here, above bar 79, maybe above bar 81. But bar 1, there's not a lot of information, and 80% of days have trading range opens. So it might be more wise to wait for more information before taking a trade. And then bar 2 was a big bull trend bar closing on its high. It's a shaved bar, no tail below or above. It's a really strong looking bull bar, but the context is bad. Remember, I draw this from time to time to demonstrate it. We can imagine the gap down as just a big bear trend bar. And so you see this bull trend bar, it looks very strong. But do you really want to buy this bar after such a big breakout? Probably not. This is probably a minor reversal. And again, given the context, the big gap down after a small pullback, bear trend, strong bear bar on bar 1, bad buy signal bar, probably sellers above 1. Bar 2 might be more of a sell to close bar, big down, big up. Might be in a minor trading range here. But bar 2 is strong enough for a second leg up. However, this is a minor leg 1, so probably sellers above, scaling in higher. Bar 3, disappointing for the bulls, so we have a bull breakout bar and then bad follow through. Bar 3 is a low 1 short, small signal bar, and it's a doji. Some traders might sell below it, but they'll use a wide stop, and they're willing to scale in, maybe on a low 2 or low 3. So bar 3, there might be bulls buying below for a scalp, but we're far below the moving average. And again, bar 2 compared to the size of the gap down, plus bar 1. Bulls know this is a minor reversal. And if they are buying, they're buying for a scalp. 4, we sold off and pulled back. Now we have a high 1 for the bulls. Rallied on 2, pulled back, and then bar 4 is the high 1 signal bar. The problem with the high 1 here is that if you're buying above a high 1, you're buying a second leg against a major breakout. The odds are there's sellers above 4, scaling in higher. And for always in right now, the market is probably always in short. 5 rallied to the upper half of the bar 4 range and then reversed back down, closing on its low. Disappointing for the bulls and for the bears. Now they are getting 2-3 consecutive bear bars, 2 of them closing below their midpoints in a 3-bar micro channel. Also, bar 1 is currently the low of the day, and bar 1 remains the low of the day about 20% of the time. So we're probably going lower, at least below bar 1. And again, when you think about the fundamentals of breakouts and second legs, and that the market likes symmetry, we can view the gap down and bar 1 as a breakout. Maybe this is a pullback, and then we can get a second leg down, similar in size to this breakout. So we could fall all the way down here. 6, we're getting 4 consecutive bear bars. Might be sell to close. The bulls are hoping we get a double bottom, but the context, again, is bad. There's been 1 bull bar today. Four consecutive bear bars. 6 right now is the double bottom signal bar for the bulls. More likely sellers above for a second leg down. This was strong enough for a second leg, and it might be the start of the major second leg down. So probably sellers above. Some traders will buy below bar 2, betting it was strong enough for a second leg, and it's enough of a surprise that the market might be in a trading range. They can buy below. Here's a deep pullback, maybe a couple legs down. We sold off on 4, rallied up to 5, sold off for a second time. So there might be buyers below, but this momentum looks too strong to be buying a double bottom here. Far below the average price and only 1 bull bar. And then 7, we have a bear reversal bar closing on its low. 5 consecutive bear bars, still a micro channel, and really not a good signal bar for the bulls, so probably sellers above and going lower. More likely, we are always in short and will fall for a measured move down before a measured move up. And then 8, a little bit of a surprise bar. Big breakout bar, probably going lower. This sell-off is all 1 leg. It's a simple leg. There's been no pullbacks. But on a smaller time frame, it's minor legs down. We have 1 pullback, 2 pause, 3. And so we might have profit taking on the close of bar 8. But any reversal here is more due to bears taking profits than bulls looking to buy aggressively. So we might bounce here, but it's minor. I also want to draw that leg 2 measured move. So the gap down plus bar 1 being leg 1. And then from the high of bar 3, projected down for leg 2. So there's our leg 2 measured move. Too much momentum to be buying, even if you do suspect it's 3 legs down. It's a parabolic wedge, which is a breakout on a higher time frame. And even on this time frame, it's a breakout. So not wise to be buying for a fade here. And then 9, the bears got follow through. We're falling quickly to this measured move target. But traders are interested to see how the market behaves at support levels like measured move targets. Now we have a breakout and follow through, bars 8 and 9. And that's strong enough for its own second leg. However, my concern with selling down here is that we're getting close to that leg 2 measured move. And after a trend day like yesterday, the expectation is sideways to up price action starting within the first 2 hours. So some sort of correction. So we had a bear trend, and now we're getting sort of a climactic gap down and then another climactic breakout. This actually isn't as great for the bears as it seems. The bears want something like this. This is the stop order's dream. It's controlled, the bars are uniform in size, it's not climactic, and it just goes on and on. And then you look at today, huge gap down, that's climactic. Then you get a bar like bar 2. Where did the bulls get a bar like bar 2, a big shaved bull trend bar all through here? They didn't. And then a parabolic breakout here, bars 8 and 9. It's a sell vacuum. The bears are controlling price, but we don't know how much of that is due to aggressive bears selling versus strong bulls just stepping aside, looking to buy lower. 8 and 9, you can sell the close, and we're probably going to get a second leg down and go lower. But the one concern is that this is climactic, and the odds of getting consecutive small pullback bear trend days in a row is unlikely. Inside bar on 10, minor reversal, bears taking profits. Low one short below 10, probably buyers below. Because we have this measured move target, it's climactic. Bears who sold here had this relatively deep pullback, and in terms of the entire breakout, it's not deep. But if a bear sold the close of 9, bar 10 almost retraced the entire range of bar 9. So this is fairly disappointing. There might be buyers below. And then 11, a small trading range bar. So the momentum is fading. So again, just to compare it to over here, this is sustained selling. It's really, the bears are controlling price and time. It's orderly. And then over here, acceleration and then a deep pullback. Acceleration getting even more climactic, and then a couple of small trading range bars. So where's the momentum going? Bears, the problem with climactic bars like 8 and 9, you had bears selling for any reason higher, and then you get these big bars, and that will attract profit taking. Again, where did the bears have that kind of behavior yesterday? There really wasn't any big climactic bear bars that bears wanted to take profits on. These types of bars will shake stop order traders out of trades, and I think that's what we're getting here. I know I've said it in past videos. Climactic bars, trend bars, they typically lead to 1 to 3 bars of sideways trading. 11's a bad high one. There's probably sellers above. We have the measured move target just below, and we're probably going to get there. But we could pull back first. However, this is still strong enough for a second leg down. And then 12, we triggered the high one above 11, which of course was weak. And 12 is a bad entry bar. It's a bull bar, but it did not close above the prior bar. The past 3 bars have been sideways. Now we have a low 2 below 12. Bears and bulls might buy below it. Bulls buying for a scalp, bears buying to take profits. And probably sellers above, and sellers at the high of bar 10. 13 rallied a little further, but for the bulls, might be 2 or 3 legs up. We rallied on 11, pulled back, rallied on 12, pulled back, and then rallied on 13, and reversed down. We also tested the high of bar 10, which is the top of a small trading range, and this is a bear flag. We have this bear trend. We're going sideways. Now we have a low 2 short below 13. So the bulls who are buying for any reason will probably exit below 13 and look to buy lower. However, with the climactic behavior and the measured move target just below, the downside might be limited. But for now, it is a tight bear channel and still always in short. 13, strong trend bar, but you can see it stopped at that leg 2 measured move. So it might simply be a sell vacuum test of support. Bear breakout, but the bears still need follow through. But at this point, still no reason to buy, and still always in short, okay to be short. 15, we had a bull bar. It looks like the bears are taking profits at the leg 2 measured move. Now the bulls will argue they have a second reversal. We reversed above 11, came to a lower low, and then 15, you could buy above it as a second reversal. The problem is you don't have a trendline break or a meaningful trendline break at this point. This is still within the tight bear channel, so the bulls have to do more. And then 16, strong bull trend bar, but possibly just a vacuum test of resistance at the top of this trading range. It's a good bar for the bulls, and they might start getting a trendline break, and that's good, but we still probably need a retest of the bear trend's lows. So right now, this is still minor. You can say 13 is a major lower high. Here's a high, lower high, lower high, and then we broke out to a new low with a decent close. But if we get above 13, the market would then have a higher high. Here's a high and then a higher high. And bear trends do not have higher highs. So at that point, the market is either in an opposite trend, a bull trend, or a trading range. The bulls are hoping that 15, 16 is enough to disappoint the bears so that anyone who shorted lower will buy back their shorts. Maybe the bulls create a major trend reversal with a higher low, double bottom, maybe head and shoulders. But for now, strong enough up for a second leg, but again, we might be at resistance, so 16 might be more of a sell the close bar. Then 17, we went a little higher. We did create a higher high, but then reversed down. So at this point, we might have an expanding triangle. And this could either be a bear flag or a reversal pattern. 17, strong bear bar, but following consecutive bull bars, one of them being strong and fairly big. Probably buyers below 15. The bulls, they know that this was strong enough for a second leg, and it may have disappointed the bears. But now, it's common to get sell vacuums after minor reversals like this, testing the lows only to reverse back up. That's kind of the logic behind expanding triangles. And there was a pretty good example of that on Tuesday. Right in here, maybe we've had 2 legs down and then a decent bull bar, but bulls don't want to buy above or on the close of this bar, so the bulls step aside, strong enough leg down for the bears for a second leg, so bears see 32. It's a bear channel. They sell rallies, so they can sell the close. There's a relative lack of buyers here, bulls stepping aside, and bears willing to sell. Then we get a vacuum test below the bar, only to reverse back up. So 17 is, you can call it a low 1, you could also call it a low 2 or a low 3. It all depends on how you look at it. Bar 10 could be the low 1, bar 13 the low 2, and then 17 a low 3, 1, 2, 3. But if you look at this rally as a breakout, this is the first reversal down. It could also be seen as a low 1, but it's a strong bear bar closing on its low. Context makes sense for a deeper pullback because bulls, again, would rather buy below the breakout. And the fact that 17 sold off this strongly shows you that bears or that bulls were not looking to buy the 50% pullback. Of that minor reversal. Here's 50%, it closed below it. 18, follow through for the bears, but again, might be an expanding triangle. Big up, big down, maybe 1, 2, 3. This might be a final flag. The market's going sideways. Any bear breakout could reverse, and the market could convert into a trading range. Consecutive bear bars, and might go a little lower, but I do suspect there are buyers below 15. And the market looks like it's in a trading range here with a higher high. 19, we poked below 15, but did not go very far. 3 bear bars down, but lots of overlap. Just look to the left. Trading range price action. 3 pushes down. And far from the moving average. So now we're far from the moving average. The market is very cheap, but the price action is more sideways. It's okay to sell far below the moving average when you're getting far above average bearishness. But in this case, the market's sideways. So probably buyers below. Bears taking profits and bulls looking to buy below for a second leg up. And then 20, we had a bull reversal bar. Following a 3-bar micro channel, it's not a high probability buy. It's also a small bar. So if you do buy above 20, you have to be willing to use a wide stop and scale in lower. One way you could do that you could take a measured move of the bar and then maybe put a stop 2 times the range below the bar down here. And even though it's a 3-bar micro channel, it might be a third leg down and overall low in a trading range. So there's an increased chance that we do get the reversal up. Also the major trend reversal argument, tight bear channel, trend line break, retest of the lows, not particularly strong because it's a couple of good bear bars, but right after these bull bars, it's big up, big down, and then failing to break out at the new low. And then 21, we have a doji, but the significance of the tail on 21 is that it's a trendline break. And it's pretty fascinating. I remember discovering this for the first time and really for it becoming clear for me that tails on bars are failed breakouts. But you have to remember at some point, bar 21 was on its high. And you think about this sell-off on the minor time frame. Here's a bear trend. Here's a trend line break. And then the market's retesting the lows. And you think about what's going to happen below bar 21. 21 went a fair distance above 20. So if a bear sold above 20, betting micro channel, sellers above, and then get a second leg, 21 went maybe 10 points against them, and that's disappointing. Plus 21 is now a low 1 signal bar, possibly at the bottom of an expanding triangle or some type of trading range. The odds are there's buyers below 21, and what we might have here is a nested major trend reversal pattern. Bear trend, trend line break, retest of the lows, and then reversal up, and then here, bear trend, trend line break, retest of the lows, expecting buyers below, and then probably more to the upside. So even though 21 looks like a weak bar, the rally from 20 to the high of 21 was strong enough for buyers below and a second leg up. Inside bar 22, it's a low probability for expecting a breakout. Trading range bars are, or inside bars are trading range bars. The market's contracting. In this case, we might be low in a trading range, and it's probably, if I had to choose, I'd rather buy above the bar than sell below the bar. It's a low 1 short at the bottom of an expanding triangle where we're getting a lot of overlap, dojis, big up, big down, disappointing follow through for the bears. This breakout got the minimum follow through. It's a spike and very weak channel, but it did get a second and third leg. And I mentioned the market likes symmetry, so why aren't we getting a big second leg down like this, down to here? A couple of problems I have with that is that we already had this gap down. This is already a second leg. Plus, remember what I mentioned, that this is climactic, and then look at the momentum here. Climactic breakout, bad follow through. The market's going sideways. So I think more likely bears are disappointed by this. This expanding triangle, bear channel line is support. There's probably buyers below. So even though you can bet on breakouts failing of inside bars, I think it's more dangerous to sell above this bar, fading that breakout with an increased risk that we get a vacuum test of support like the close of 16 or the moving average. Outside up 23, testing the channel line. Now we have a bull reversal bar closing on its high. It's a reasonable stop order trade. With everything I've been saying, possible wedge bottom, second reversal, we reversed above 20 with a decent breakout on 21, even though the close is weak. I've said this before. Breakout distance is more important than the close of the bar. I'll actually pull that up. Let's look at 11.25 on a 100-second chart. For some reason, the 100-second chart doesn't like to load for me, but the 1-minute chart will show us the same pattern. So 11.25 right here. You can see all the overlap. There's pretty deep pullbacks for the bears, decent micro channel for the bears, but then a deep pullback to a new high. So that's the expanding triangle. We have a higher high here, and then here's a retest of the lows. Market's going sideways, and then the major trend reversal I'm talking about is here's a bear trend. Here's a trend line break. The bar closed down here. This is that doji 21. So even though the bar closed down here, the breakout disappointed the bears. So any retest will likely lead to buyers below. And that brings us to here. Retest of the lows, 2 legs down, pretty weak. Double bottom, possible major trend reversal. Bear channel, so bull flag. Upside breakout, more likely. So a couple of reasons for bears to get out down here, and bulls can buy, taking a chance on a swing up. So like I said, it's a reasonable stop order buy above 23. It's an always in. Well, it's not an always in flip at this point. The context might be always in long at this point. But if you think about always in the way Al talks about it, where you need consecutive bull bars, at least one being big, closing on its high, then of course we don't have that here. But what we have is a possible final flag, major trend reversal setup. Also, just one more thing. Just think about the day structure and the context. 2 big legs down. And I said earlier, it's unlikely that we have another small pullback bear trend that lasts all day. More likely we end up going sideways. So this might be a bear leg in a trading range, and we can come back and test all the way up to maybe the bar 2 low. That's a breakout point. And if this is a trading range, breakout points get retested. Buying below bar 2 was a reasonable trade, and traders got trapped. So what I was saying here, it's not necessarily always in long, at least with the price action. Context, you could argue it. But the point I was trying to make is that 23 is a bar that always in bears will exit above. And if always in bears exit above 23, it's a reasonable second entry long. Then that means always in bulls can buy above it, taking a chance for a swing up. So you might have more buyers above 23. 24 is a weak entry bar for the buy. It's also the close of the second hour. So you think about the 60-minute chart. The first hour opened near its high, closed near its low, decent bear bar. But think about the second hour. We went sideways. It's a bear body. We opened here and closed a little lower, but big tail above and below. So bear breakout bar, but bad follow through. So it might be buyers at the new low if we get below 23. If you're buying below 23, probably not ideal to use a tight stop, because this is a bear channel, and the odds are if we fall below 23, there are buyers below, so better to use a wide stop and be willing to scale in. 24 is a low too. It's a weak signal bar, and the context is bad. Probably buyers below 24. 24 is not a very good stop order signal bar, but the context is good to be long. 25, small bull trend bar, and if we think about the bear perspective, now we have a second reversal where the bulls did not get stopped out below 23 on 24, and now 25 is a bull bar closing on its high, and it's a 3-bar micro channel. So again, bears might be inclined to exit above 25 and we might, at a minimum, get a test of the moving average and the 16 close. And then we had a buy vacuum test of those resistance areas on 26. There were sellers into the close. It makes sense. We're testing an area where bulls got trapped on the close of 16, plus the first test of the moving average. However, at this point, the bear trend argument is getting damaged and it's weakening. We have this higher high on 16 or 17, and it's mostly sideways here. This looks like a trading range for close to 20 bars now. And when the market goes sideways for 20 or more bars, breakout direction becomes very close to 50-50. 4-bar micro channel, weak, sell signal bar below 26, probably buyers below. 27 breaking out further. This is a decent bull breakout. Now, if you think about it, what leg is this bull leg? Is it leg 1? Is it leg 2? Is it leg 3? Nobody really knows, and you can look at it in any of the ways. You can look at it as 1, 2, 3. You can look at it as this rally, 1 and then 2. Or you could say this is breakout mode. It's an expanding triangle. Possible, maybe lower low, major trend reversal, and then this is a new breakout, and this is leg 1. The reality is that the rally up to bar 27 is strong enough for a second leg. So a lot of traders might look at this as a leg 1 breakout, 3 consecutive bull bars with a micro gap, and 27 closing on its high, fairly far above the moving average. 80% of breakouts pull back, so it's likely we'll pull back first, but the odds are we'll get a second leg up. Are we going to get to the bar 2 low? I'm not sure at this point. If the bulls get another strong bull trend bar on 28, of course it's more likely, but we need to see the follow through. And then 28 was disappointing follow through. We broke out through the moving average, pulled back and tested it, and that test got bought. So any bear that sold the first moving average test and got trapped had a chance to exit, and here's a breakout pullback and traders bought. But we have a bad sell signal bar on 28. Micro channel, doji, probably buyers below for a second leg. Now, do I think we're going for a measured move of this breakout? Probably not. When you think about the context and just look at the bars to the left, this sell-off is bigger and stronger than this rally. And so I still think we're getting a second leg and we'll go higher. However, we're not necessarily going to get a measured move of the breakout. Breakouts in trading ranges fail to go very far. So the best case scenario for the bulls might be a leg 1 pullback, leg 2 measured move. Inside bar 29, it's a weak signal bar or it's a decent signal bar for the bears, bear bar closing on its low, but the context is bad. The first reversal down after a micro channel, strong enough breakout for a second leg up, trading range bar, and then an inside bar. The odds are there's buyers below. And then 30 rallied. Is bar 30 the second leg up, leg 1, pullback, leg 2? I don't think so. I think we see situations like this fairly often. You can even argue the same thing happened earlier in the day. Here's a big leg 1 with then a small second leg, but that's really just part of the first leg, and then a deeper pullback, and maybe that was the second leg. I think here, this is all just the first leg. Markets are fractal, and so we have that small second leg, that is true, but we technically don't have a pullback yet. We haven't had a bar fall below the low of the prior bar since all the way down here. So all this is probably leg 1. Maybe we get a complex 2-legged pullback and then a second leg. We can see that 30 rallied to a new swing high and there were sellers above. So the market's already channeling up. The bulls are taking profits above bar 28. They're not willing to buy up here. 30, it's a weak stop order sell. There's probably buyers below. Inside bar 31, it's a high one, but 2 legs up and in an area where bulls just sold. So probably sellers above, and we'll probably get a deeper pullback, maybe test the close of bar 29. And then sellers above, we reverse down. Second reversal, technically it's the first one because it's a micro channel, so it increases the odds there are buyers below. But here's the first reversal, and then the second one below 32. Do always in bulls get out below 32? I don't think so. I think it's a tight enough rally. We haven't had a trend line break yet, but we might get a trend line break here that disappoints the bulls, and then they sell at a retest of the highs. Bears might sell for a scalp, but not a very good swing. 33, bear breakout, falling below the moving average, but closing around its midpoint. It could have been stronger. Maybe now it's two legs. One, pullback, two. 33 is a bad stop order signal bar for buying above. The odds are there's sellers above, but they may not come in until a new high. And then 34 was a good entry bar for stop order bulls. So any bear that sold above 33, their entry bar is 34. They might use any small pullback, if they're fortunate enough to get one on 35, to exit at their original entry. Otherwise, they might just buy the close of 34, give up on the short, and then look to sell higher. Also, with the leg 1, leg 2 measured move, maybe we have the bull breakout. Using the bodies. This is the most conservative way to do it. Use the bodies first, and then put it on the tail, 33. So maybe the bulls get to here, and that's close to the bar 2 low. So maybe we'll get there as well. Similar resistance areas. Let me just redraw that. So that lower line, just get rid of that for now. This is our leg 2 measured move. The bulls got follow through, but it's minimum follow through. The bar closed below its midpoint. Now we might have a wedge top. The signal bar is weak. It's a bull close, consecutive bull bars. Probably buyers below 35. For the bears, they might look to sell above 35, scale in higher, betting this is a bull leg in a trading range, and we'll come back down and test the lows. 36 continuing higher. We have a nested spike and channel, spike, pullback, channel, and then here, bar 34 was a bull spike, and 35 and 36 are channeling up. So the upside is probably limited. We have this bull channel line, probably sellers above, and it's 3 pushes up, 1, 2, 3, and here it's 1, 2, so maybe one more push will be 3. It's a nested wedge with increased chance of sellers above. 37 pulled back below 36, but it was a 4-bar micro channel. 3 bars without a bear body. It's a weak signal bar for selling. I mentioned that on 35, and I think I forgot to mention that on 36, but the odds were there's buyers below for a scalp. But then 37 is a high 1, bad context, more likely sellers above. Inside bar 38, high 1, top of a channel, 4 bars sideways. The odds are sellers above, buyers below. And then 39 rallied to, it looks like it tested the leg 2 measured move to the tick and then sold off. So again, what I was explaining here, here's our bull channel line, spike and channel, bull trend, and then in here, 1, 2, 3. So increased chance that we have sellers here. Bulls might be uninterested to buy for 10 bars and 2 legs, maybe a test down to the low of 33 at a minimum. But if this entire day is a trading range day, we could come all the way back down and test the lows. The problem I have with rallying up to test the highs, in other words, what are the odds we have a big down, big up, and this entire range is the trading range. So here's the top of the range, here's the bottom, and then we rally up here. The problem I have is the momentum. This was stronger momentum, sort of the defining characteristic of the day. And then this rally is much weaker. and we're already getting a spike in channel bull trend that looks like it's ending here on 39. When you think about the market cycle, leg count and the market cycle go hand in hand. We have leg 1, leg 2, leg 3, or leg 1, leg 2, leg 3. Always different ways to look at it. Markets are fractal. Even here, breakout, channel, 1, 2, 3. A lot of different ways that you look at it. This looks like a resistance area, top of a bull channel. It was also a test of the leg 2 measured move that I had drawn. The expectation is that you have a breakout, the breakout pulls back, converts into a channel, the channel converts into a trading range, and we can come back and test the low of 33. The increased risk for the bulls here is that we don't stop here, and again, we come back and test these lows. I think it's more likely we test the lows than the highs because of this. 36 is not a strong signal bar for selling below, but the context makes sense. So it's not the worst stop order sell below 39. It's the minimum signal bar. It's closing below its midpoint, so it's a sell reversal bar. And then a good entry bar for the bears 40, although it didn't cross the moving average. The moving average here is basically flat. So a close below the moving average in this context is less important. This was good for the bulls to rally above the moving average, but here, mostly sideways, big down, big up, and then you're getting a good bear bar on 40. More bulls might give up, seeing that it's 3 legs up. More bears might sell, at least looking for a test of 33, and I want to keep that support line drawn and see how the market reacts if we get there. And then 41 vacuumed straight down to that price. It did stop there, but these bars are strong enough for a second leg, probably going at least a little bit lower. And what are the targets below? 24, remember I said 24 was a weak stop order signal bar, and then we got a decent bull breakout out of it. So that will be a magnet, and that will become support. We could also come back and test the low of the day. So bear breakout and follow through, crossing the moving average. Good looking bear bars. Again, probably going lower. It's sort of a minor leg 1 major, or how do I want to phrase it? This is a more major breakout, and then these breakouts here, 15, 16, 17, 18, up to 27 down here. These are minor breakouts within trading ranges, but this is a strong minor leg 1 breakout. So the expectation is at least a small second leg down. 42, we paused, went sideways, bears taking profits at the bottom of the trading range, or what could be the bottom of the trading range. But now let's think about the bull case. 3 legs down, possible wedge, bull flag, bull breakout, complex, maybe expanding triangle, bull flag. So what about buying above 42? Well, I said 40 and 41 were strong enough for a second leg down. We haven't had it yet. And compare the strength of 42 to the bear breakout. It's a doji trading range bar. So we're probably going to find sellers above and at least a small second leg. The bulls probably need at least a second reversal here. 43 more sideways, but a bear close. Might be channeling down, spike, and channel. Buyers below these bars and sellers above. It is a micro channel. The odds are there's sellers above these bars. But as far as selling below them, you might be selling near a support area below trading range bars, so not ideal. Inside bar 44, but right below the moving average. It's an inside bar. We have a tight trading range. Breakouts likely to fail. And then we had an outside bar, 45, failed breakout below. Outside bars are expanding triangles. In this context, we might have an expanding triangle, bear flag, bear breakout, sideways, 45 might be better to sell above the bar. Still expecting a second leg down. Weak follow through for the bulls, so 45 consecutive bull bars. Outside bar, it's a breakout bar, but then disappointing follow through. So bulls might give up. Maybe it's 2 legs up, 42, pull back, and then 45, low 2 short below 47. Good entry bar for the bears. Probably going at least a little bit lower. Still might have 3 pushes down, testing this support. So the downside might be limited, but bears can sell for a scalp here. Bulls might step aside. Unfortunately, something just came up for me, and I have to cut this one short. But we can see what happened. Bear breakout, second leg, lots of small bars. The market's channeling down, getting lower in the range. We're testing that bad signal bar, not getting below it. And then 59.60, that's a strong minor leg 1 breakout, strong enough for a second leg up, and maybe a test of the top of this range. Pause bar, bad sell, you can buy below, probably get a second leg. Complex pullback, going sideways to up. Finally a late breakout, but sellers above, probably going to go more sideways into the close. Big down, big up. And then another rally, getting close to that prior high, but not quite there. For always in today, coming into the day, the market was always in short through here, but I mentioned somewhere in here, when it becomes two-sided trading, you want to buy low and sell high rather than just hold short. And I thought above 23, bulls could buy, maybe always in long. And then the same applies over here. Once you get 3 legs up, might be always in short. And better to just think in terms of buy low, sell high on trading range days. And then for stop orders, you could probably sell below 3, taking a chance, but better to sell below a bear bar, closing near its low, like 5 or 6, even 7. Betting the double bottom will fail. You could sell below 8, expecting more to the downside in a second leg. Low 1 below, or again, maybe low 1, low 3, below 17. Good for a scalp to a new low, but not a swing trade. And then you can see the bad follow through there. Thought it was reasonable to buy above 23 for a swing, buy above 25, 26, 27 for a second leg. And then I thought you could sell below 39, 40 probably better, bear bar closing below its midpoint. You could even sell below 41, betting on a second leg down. Low 2, below 46, you could sell below. Breakout mode down here. Better to wait for the breakout. You could buy above 59 or 60, breakout bar, or wait for the follow through. And then maybe a 2 or 3 legged pullback. You could buy above 68 or 69 for a second leg. But through here, it's pretty tight, not ideal for stop orders. For limit orders, you could sell above bar 1. I thought you could buy below 2, although when you get 4 consecutive bear bars, not ideal. And if you do buy, you think about it, if you bought and your entry bar is 6, and then you get bar 7, that's not, your premise is no longer valid. If you're buying below bar 2, you're expecting a bounce, you don't get it. So what do? Limit order bears give up. We have this give up bar and follow through. Low 1 below 10, but probably buyers below. Bad, buy above 11. You could sell above. And then I thought buyers below 11. And then this big up, strong enough for a second leg, but deep pullback likely. Buyers below 15. 20, unlikely to lead to to be the low of the day and lead to a big rally. You could sell above it, micro channel. Context wasn't great throughout, though it's 3 legs down. 22, you could buy below. Strong enough breakout for a second leg. Buyers below, but the pullback didn't come until all the way up here. And buying below a bear bar, second entry short, not ideal, but buying below 30 would have been better. High 1 above 38, good context, 3 legs up, tight trading range, breakouts likely to fail, so you could sell above 38. Strong enough breakout for a second leg, sell above the first pullback, inside bar, so that's probably a better sell. Or you could wait until the market rallied above 42 or 43. And then all the way down, you could sell above 51, that's a bad stop order, long, tight bear channel, strong enough for a second leg. Somewhere in here, very tight trading range. Buyers below, sellers above, but better to wait. Decent breakout, you could buy below 61. And then all through here, tight trading range, buyers below bars, sellers above bars. And today was a bear trading range day. We can see on the daily chart, here's the bar. So bear breakout and follow through, that's true, but look at the bar. It's a trading range bar, closed above its midpoint. Might be a good looking rally or sell off on the open, but the day was mostly sideways. And then where did we go Monday? Well, let me turn this back to the extended hours and talk about that really quick. The problem here for the bears is that, like I said in the beginning of the video, 3 legs down, however you want to look at it, might be testing support in a trading range, maybe this bad buy signal bar. You can see we're testing it. So we might start to go sideways here and then form a bottom. However, we don't know if the bottom of the trading range is down here or even all the way down here. But I do think we've had consecutive sell climaxes. And again, looking at the extended hours chart, these 2 bear bars are the biggest bars of the entire sell-off. And this looks like a leg in a trading range. Deep pullback, lots of overlap, sell climax, pause, sell climax, pullback, and then an even bigger sell climax. This is exhaustive, more likely to lead to bears taking profits. Bulls will start buying, will probably start to form some sort of bottom, at least temporarily, and go sideways here, especially considering the bad follow through for the bears today. And again, I apologize that I had to cut this video short. But as always, please feel free to leave questions in the comments and include timestamps for any questions specific to this video. Alright, and I hope everyone has a good night. Thanks for watching.